So, of course, the first number that you're going to look at when you turn to dividends is the yield. How much is this company paying you? And to me, the first question that raises, and I want us to answer it through kind of a healthcare lens, but also in general, Todd, is a bigger yield always better?
First, I'm so happy we're talking about this because I think this subject is very important. People are relying more and more on dividend paying stocks to boost their portfolios, to generate out retirement income. So it's great that we're having this open discussion on dividend paying stocks, the things to look for. As far as high yield stocks, no, not all dividend paying companies are created equal. And I think investors need to take a very careful look, especially in the healthcare arena, at high dividend paying stocks to see why shareholders may have sold down the shares in these stocks. And that's what's responsible for the increase in yield. Because remember, the yield is going to be a reflection not only of the share price direction, but also the payouts. So
Yeah,
those
of,
two
of
things
course,
can
if you have
cause.
if you have a percentage, it's going to be a fraction, so you can have a really high fraction because the numerator is really big, or it could reflect the denominator. So the two aspects to look at there. So if it's because the stock's price has been hammered down, then that's certainly not a good sign.
Right. I mean, if you get a very high yielding stock, like in healthcare, there's this company called PDL Biopharma that yields very high. And that people will look at that and say, oh my God, that's a great dividend. It's north of 10%. I got to own that. Problem is, the stock has been cut in half in the past year because a lot of royalties that they're earning are the contracts that they have that are paying out those royalties are ending. So, yes, you have to do your due diligence and make sure that if there's a high dividend yield, that there's no other reason why that dividend yield is high other than the stock is on sale.
Yeah, and I think it's always something to look out for when you see a yield that looks too good to be true. I mean, it could be fantastic, but for me, I would say it's about a yellow flag. If I see something that's greater than the average, I mean, the S&P 500 yields about a 2% dividend payment. So if I see more than that, it's definitely worth investigating, and maybe not a definite flag that you need to stay away, but certainly worth trying to figure out, is the yield high due to share price declining, or is it some management gimmick to keep investors interested in some otherwise uninspiring stock? There are questions to ask when you see something that's really high. But in general, if you look at a stock and it's got a solid dividend payment and you dig in a little bit, what you want to be looking for is this stable, promising future. I mean, that's really what it comes down to, is a stock that's going to continue to pay a high dividend needs to be able to find the money to pay it somewhere. So how exactly would you go about figuring out, am I going to continue receiving these dividend payments? Is my investment safe?
I always look at three things when it comes to healthcare stocks. I look at the products they have on the market currently. I look at the pipeline of drugs that are coming up through the ranks. And I look at their financial condition to make sure that they're rock solid and continue to make those payments. So to your point, yes, you want companies that are growing, not shrinking. You don't want to buy Polaroid or Radio Shack because they have a dividend yield and their businesses aren't growing. So make sure that you're looking for companies where the products that they currently market, the sales are growing. Make sure that their pipelines are filled with drugs that could be good top sellers and could offset the patent risk that exists in this industry. And then make sure that their balance sheet looks good.
Yeah, patent risk is huge right now in healthcare. I mean, it's clobbering a lot of the industry giants, and it's making a lot of these yields look super attractive. I mean, for example, you take your GlaxoSmithKline, for example. They've got a 5.84% yield, which is super high for healthcare, but they're wrestling these patent woes, and I'm not sure if they're going to be able to replace the declining respiratory portfolio.
They've launched some new drugs that they were hoping would take market share away from their Advair Discus, which is a massively important drug to this company. Selling at a $4.8 billion annualized run rate, which is about 20%, I think, of Glaxo's total revenue.
Mm-hmm.
And the patent on Discus, the inhaler device, that expires next year. So who knows when generic competition is going to enter and start eating away at that market share. But it's certainly one of those, we'll call them yellow flags again, where we're talking about, okay, we've got a high dividend yield. Why? And in this case, it's because they're losing patent protection on a very important drug.